Welcome to The Explainer. Today we're going to tackle a massive topic, this incredible mountain of global debt, and the government's quiet plan to deal with it, a plan that, directly involves your money.
It all really starts with this number right here, $338 trillion. That's the projected global debt by the end of 2025. It is an all-time high, and it represents one of the single biggest challenges facing the world economy today. Okay, so let's really dive into this mountain of debt and figure out what it actually means for all of us.
Now, this isn't a problem that's just confined to a few small countries. As you can see from this chart, the world's largest economies are the ones carrying the heaviest burdens. I mean, look at Japan. Its debt is nearly 235% of its entire economic output. The US is sitting at 125%. These are not just numbers. They are flashing red lights for global fiscal stability.
And this forces us to ask a very direct and, frankly, pretty uncomfortable question. How on earth do you solve a problem of this magnitude? I mean, the usual answers, cutting spending, raising taxes, they're politically toxic, and a lot of the time, they're just not enough.
So what do? Well, governments have a kind of secret weapon, a little-known tool they've been using for centuries to handle overwhelming debt. It's called financial repression. Financial repression isn't just one single policy. It's more like a whole toolkit. It includes things like putting caps on interest rates or creating regulations that basically force banks and pension funds to buy government bonds. There's subtle moves that, in effect, create a captive audience for government debt.
This quote from economists Carmen Reinhart and M. Belens Branchia just perfectly captures the endgame. The goal is to liquidate the debt, not by paying it off dollar for dollar, but by slowly reducing its real value over time. And they do this by keeping interest rates below the rate of inflation, which quietly, stealthily, erodes the debt and, your savings right along with it.
And look, this isn't some wild theory. It's literally happened before. After World War II, U.S. debt was over 100% of its GDP. For the next 30 years, a mix of policies, like the 1951 Fed Treasury Accord that capped interest rates, successfully chipped away at that massive debt pile. It actually worked.
So you might be thinking, if it worked then, why not just run the same playbook today? Well, the game has changed dramatically.
Think about it. Back then, the economy was a relatively closed system. Capital couldn't just zip across borders with the click of a button. But today? Today's financial system is totally globalized. Money moves instantly. And crucially, there are now non-state digital alternatives for that money to flee to, which simply did not exist before.
And beyond just the practical challenges of trying to trap capital today, recent analysis of that whole post-war period has uncovered a really dangerous side effect of these policies.
This insight from DIW Berlin is a bit of a bombshell. It turns out that when you repress the financial system, you also tend to repress the real economy. See, capital doesn't flow to its most productive uses, it flows where the government tells it to go. This can starve innovative companies of funding and slow down the very economic growth you need to shrink your debt. It's a dangerous trap.
So all of this, it leads to what is probably the single most important question for anyone with savings or investments right now.
I mean, let's put it bluntly. If government bonds and cash in the bank are the intended targets for this devaluation, where can you go for safety? Where can your capital flee to preserve its value?
Well, the answer seems to be what are called scarce assets, things whose supply you just can't easily inflate away. We're talking about things like physical gold, which is hard to mine, productive real estate, because, you can't print more land, or even shares in profitable companies that generate real cash flow. And of course, there's a brand new category of provably scarce digital assets. Now, of all these scarce assets, one was specifically engineered from the ground up to be immune to the very kind of debasement we've been talking about.
And this is where Bitcoin really enters the conversation as a pretty unique contender. Its whole protocol is built on a few key properties. Its supply is mathematically fixed, forever. There's no central bank to change the rules. It's accessible to anyone in the world with an internet connection, and, this is the wild part, it can be held directly by an individual without a bank, secured by just memorizing 12 words.
So as investors start to seriously consider these alternatives, governments are of course responding. And this is creating a really fascinating split in policy all around the world. What's so interesting is that we're seeing two completely different government philosophies emerge. In the US, for example, some proposals are aiming to leverage the private sector by promoting stablecoins, digital tokens backed by real dollars, to sort of extend the dollar's reach. Now, contrast that with places like Europe and China, which are actively exploring their own government-run versions, often called central bank digital currencies, or CBDCs, which could give them way more direct control.
And this right here just perfectly illustrates the stakes. This collision between unprecedented government debt, the old playbook of financial repression, and the rise of new, unstoppable technologies means the fundamental rules of money, they're being rewritten in real time. Which leaves all of us with a final and pretty provocative question. As the very definition of a safe asset changes right before our eyes, how we choose to position ourselves is going to determine whether we're simply saving in a broken system or actively working to survive and maybe even thrive in a new one.